US Treasury Bills. What are they doing lately? Let's check in on them. We're going to do so with Jeff Snider, the head of global research for Alhambra Partners. Jeff, we're going to be discussing a blog post of yours that you posted on the 8th of April, and it was called Rechecking on Bill and His Newfound Followers. That's at Alhambra Investments. And you asked two questions. They're not quite easy to understand, but before we even answer them, we're going to set the scene. But let me ask them anyhow, just to grab the audience. So here's question number one. It's fair to ask which end is actually leading. And two, more importantly, if it's the wrong end, why should that end be leading? And we're, of course, referring to the US Treasury curve, the short and the long end. But before we start addressing that question, Jeff, the context that the US Treasury yields and bonds that they find themselves in is a good one, maybe even very, very positive looking.
Everything, right? I mean, there's nothing that's going wrong right now. It seems like if there's something that we've been concerned about or should be concerned about, that's been answered and papered over, and this flood of cash and flood. I mean, we got vaccines going on. That's in this country at least is going on pretty well. There's some hiccups in other places around the world, but at least there's a vaccine and it's being handled. There's an end of a light at the end of the tunnel as far as the pandemic goes. That's one thing. Then you've got governments around the world, particularly the United States, throwing around cash like they have money trees in the backyard, trillions upon trillions. I mean, we've got a $2 trillion stimulus, quote unquote stimulus, that was done last month. We've got a $2.2 trillion infrastructure stimulus that's being offered. That was on top of the 1 trillion or nearly 1 trillion at the end of last year, the 2.2 trillion CARES Act. I mean, multiple trillions in fiscal stimulus. And then you've got, of course, the Federal Reserve, which is quantitative easing. Bank reserves are almost 4 trillion, by far the most on record. I mean, flood of cash, flood of money, reflation, pandemic over, COVID cases dropping. I mean, everything is going that could go right is going right.
What about the Treasury General Account? That's another thing that should be positive, right? The
Yes.
US Treasury is sending money back. Get this money out of here. Send it back into the economy.
Yes, the Treasury had built up this cash balance in the TGA, which is an account it holds with the Federal Reserve, which excludes it outside of the banking system. And as this latest round of stimulus goes on, these checks go out to Americans and they get spent, and all the other aspects of the bill, the fiscal bill, get acted upon. The Treasury Department is now using that TGA to send that money into the real economy, and it's being drawn down by a really significant degree. I think it's more than 750 billion, 750 billion in just 9 weeks. So there's a flood of money from the TGA going into the real economy. So you add all of these things together, and it seems like, reflation should be doing really, really well here.
Jeff, so the question is, we should be seeing inflationary activity, inflationary takeoff, or the bond market, the US Treasury bond market should be showing signs of a rout or looking forward to a better future, which means yields would be rising. And I suppose some of the yields are rising, but not the short-term ones, and that's where we're going to turn to.
Yeah, I mean, if everything really is going well and it's supposed to continue into the longer run, we would really expect to see at the longer end of the yield curve, not just yields rising as they have, but yields really exploding. And we're talking about trillions upon trillions of supposedly really good stimulus, really inflationary stimulus. If it really was inflationary stimulus, and this is something we haven't seen in the United States since World War II, this level of government intervention, and then on top of it, quantitative easing, even if that's not money printing and bank reserves, there's got to be some positive fundamental or positive sentimental impacts to that too. You combine all of these things together, an end to the pandemic, a possible end to the pandemic, getting back to normal, trillions upon trillions being flooded all over the place, and you really have to wonder, why isn't the long end selling off much more than it has? As we've shown before, as we talked about before, when you put the current sell-off in the bond market in context of previous reflationary periods, it's actually underwhelming. It's actually kind of, you look at it and you think, that's it? That's all we got? We didn't even rise as much in yields as we did in 2018 with the Tax Cut and Jobs Act. which wasn't really that big of a difference. I mean, compared to the amount of government deficit borrowing and stimulus that's going on today, it's a drop in the bucket. So why isn't the long end selling off more than it has? And then when we break apart the long end of the bond market, we start to see, well, we look at inflation break-evens. Some of the break-evens have broken down. The TIPS curve is inverted, which means longer-term inflation expectations are much lower than the short run, which already the market's saying, well, maybe this isn't inflationary longer term. And then you've got the short end of the yield curve, the bills, which have been heavily bid, as you were just showing there, Emil. The short end, which is the bills, and even all the bills now are being bid up. The yields falling, including all the way out to the 12-month. I think the 12-month bill yield is down to 5 basis points, which is completely diverging from where the notes are. The 2-year Treasury note is still rising somewhat in yield, whereas the bills are all shrinking. And it's fair to ask, okay, which end of the curve is really influencing the rest of the entire reflationary trend? And up until recently, you would say, well, the bill part of it kind of got some mainstream notice a couple months ago, but then it all just kind of went away in the flood of reflationary euphoria over the fact that the bond market actually was selling off at the long end. Even though it really didn't sell off all that much, it was made out to be this historic, massive thing. I mean, the headlines at the end of March were talking about how this is the worst quarter for the Treasury market since 1980, when in fact, well, yeah, maybe it was the worst calendar quarter, but who thinks of things in regular calendar quarter intervals? In fact, as we said before, the bond market sell-off, despite all of these things going right, is truly underwhelming. And that just draws our attention back to the short end.
So for those of you who are listening, I have been pulling the graph on and off I'm trying to time whether or not Jeff is going to talk about the short end or not. Great, Jeff. So you told us a lot there. And so I wanted to pull up this graph because there's a few things happening on this chart. There's 3 market rates, US Treasury rates. And then there's 2 that I like to think of as more like, Fed determined rates. And the first one is the interest on excess reserves. And that's the big, thick red line cutting across the middle at 10 basis points. And then we have the effective federal funds rate. And that one reached up to the interest on excess reserves. Now, quick question. Is that interest on excess reserves line supposed to serve as a ceiling for the effective federal funds rate?
Here we go again with the ceiling versus floor. No,
because it's important. Like we're looking at a few rates here, and some of them are Fed determined, and therefore the market should behave like so. So I just want to draw that out as we look at that. Is the market behaving as the Fed hopes it should?
Well, the Fed looks at IOER as a double floor, which is kind of confusing because the effective federal funds rate is obviously below the 1 floor. And so the double floor is IOER is the depository floor, which applies to depository institutions who are eligible to receive IOER. And the RRP, which is not pictured here, but is set at 0, that is the wholesale floor. So that's how they look at the depository, or the two tools they use to influence interest rates. And the relationship between effective federal funds and IOER is something we talked about a lot during 2019 when effective federal funds went above IOER, which should have been a point at which depositories said, look, I don't need IOER. Federal funds is above that. Why don't I lend into federal funds and bring that market rate back down? And the fact that it never did, and it really is, it's not necessarily ceiling, it's a trigger point that's supposed to get banks thinking about whether or not they want to lend in federal funds because it's at a rate that's better than they're getting at IOER. Therefore, it's not necessarily it's not a ceiling, but it's one of the things that should influence where federal funds can go. It really shouldn't be able to go too much higher than IOER.
Got it. And right now, federal funds hasn't changed too much, but it has come down a little bit. Do you find that concerning that it's dropped a few basis points? I think, what's it at right now, 7?
Yeah, it's been flat at 7, except for the quarter end, going back to the middle of February, ironically around the 25th. But anyway, what I find curious about federal funds is, as this flood of TGA money gets converted into bank reserves, it's supposed to depress all sorts of money market rates. Yet here we see federal funds, which is a really rinky-dink market nowadays. Why isn't the flood of money, if it's a flood of money, influencing the federal funds rate more than a couple basis points from where it was in January? The fact that it's at 7 basis points, where bill yields, even the 12-month bill yield is now down to 5 basis points. What we're seeing is then the market is saying something else besides this supposed alleged TGA flood must be influencing only the Treasury bills. Now, some people would say, well, that's money market funds, because money market funds are required to invest in only 12 months or 1 year and less securities. But to me, it's an interesting, in the collateral context, the timing and all of this other thing, especially related to federal funds, where we don't see anything except for bill yields.
Now we've moved down the page, and what we see now are bill yields and the longer term, the 3 years, the 7 years, the 2 years, the 5 year. And we see a divergence there. But I guess we've already talked about this. The idea is, yeah, they're diverging and they're reflating as they should be, but they're not reflating as much as we have seen in previous reflationary episodes since 2008, let alone a normal economic environment like the 90s, or I wouldn't say normal, but employed, or people were employed during the 2000s. So
yeah, and we talked about this before. Emil, remember, this is 2013. This is very reminiscent of 2013, especially May, June, July, August, the summer of 2013, when you saw bill yields drop in reflation and long end. It was almost exactly the same setup. And then, of course, we had all those problems with repo, special rates and things like that, collateral shortages that were indicated there. And it was, going into 2014, when it was supposed to be everything going positive, instead we started to see reflation trades fall off. The US dollar started to rise, particularly against the Chinese currency. And then, of course, long-term Treasury yields began to fall as well. So it's interesting that we see the divergence. We got reflation in the notes and bonds, but something else in the bills. And now it's the question that I asked at the beginning was, which end is really the one that's influencing behavior?
Well, can you answer that for us as we summarize this article?
Well, it's, all of the stuff is short run, so there's no definitive answer here, but it's interesting, as we talked about also February 25th and after, that a lot of the global marketplace, including tips in US Treasuries, since February 25th, reflation has almost disappeared. It's, most rates, they aren't falling again, but they're at least moving sideways. They're not rising like they would, given how you would expect the market to behave with so much stimulus, this flood of cash, this inflation that everybody says is coming. Oh, PPI rates that are through the roof, right? All of these things that are enormously positive, yet the global bond market is saying, first of all, it's not that impressive, and second of all, we're not sure something isn't going wrong since February 25th. And that's really the story at the front end of the bills. And I think what's going on since February 25th is a reminder that this is a fragile system, and it doesn't matter how many trillions the Federal Reserve comes up with bank reserves. Those don't really matter. What really does matter is everything else. And when we look at, why do we care about the FedWire on February 24th? What really happened on that day wasn't really a big deal. It was a 3 or 4 hour shutdown, maybe not a 3 hour shutdown in FedWire, which caused a little bit of a headache. But it was the response to it, which was the enormous Treasury sell-off the day after, especially the 7-year auction that didn't go all that well. That was dealers again stepping back. And it was very reminiscent of September 2019, what we learned about from another event that shouldn't have been a big deal. It was a reminder that if the smallest little thing starts to go wrong, it has an enormous impact. And that kind of asymmetry is essentially, it's a risk. It's something that you have to look at and say, this is a fragile system. And that's what I think that's what the bill yields are saying. And I think that's why reflation has been so underwhelming and has, in many parts of the system, for the last month and a half now, sort of almost disappeared.
And not just the American system. We've been talking about American yields, but we have seen the February 24th, 5th, 6th reverberate. Where have we seen it? We've seen it in short-term German sovereign bonds, notes, the New Zealand currency, the Chinese currency, copper, oil.
Yeah,
What am I
commodities
missing?
too. It's pretty universal how it shows up, and it's one of those things. Everything is going right. Trillions, trillions, trillions. We've never seen this much. Why isn't the market behaving differently? Why is the market stepping back and saying, we're not too sure about what's going on here, when everything supposedly is going right?
But you don't actually ever answer that in your articles. Why? Other than just the system is fragile and we haven't seen something that will really change and pull us out of the ditch that we've been in for 15, 20 years, which, just a little bit of an occasional outburst of stimulus, the perpetual monetary policies, that's not going to get us out, right? That's the problem. That's what hasn't changed.
Yeah, and I think more recently what's changed is people are starting to evaluate, or the markets are starting to reevaluate not just stimulus, whether it actually is effective, but really, are we really recovering at a rate we need to be recovering? If we're not, and I'm particularly thinking about China, if we're not recovering at the rate we need to, we're not going to get as far and as fast as the global economy really needs to reduce the risks in the financial system, then that makes beyond the short run much more murky, which is itself a risk. And that's something you have to account for in terms of, setting, how many treasuries you want to buy and hold and things like that. Dealer activities, balance sheet capacities, they're all governed by risk perception. And so if you think that stimulus isn't necessarily helpful, and even if it is helpful, it may not be helpful beyond the short run, again, thinking about the inverted tips curve, what happens after all of that? What happens next? What happens later this year? And if later this year isn't as good as people seem to be thinking right now, or at least the mainstream media seems to be writing up this inflationary fire that's coming down the road, what if that's not the case? That's when you don't reevaluate then when it happens, you start anticipating all of these things before it. And if the bond market is saying, we're not really sure what comes next, we were happy that all of this government action was going to happen. Now that it's happened, it's now what? What really is going to follow the short run?
A good example of that, where we have this great headline, but then underneath in the details, there's uncertainty, could be the March payroll report in the United States. Great, but underneath, some unsettling observations, and that's what we're going to talk about in part 3.
But first, this from Eurodollar Enterprises. Friends, are you confused by the financial press? Are the pretty people on Bloomberg speaking in paradox? Are the esteemed pages of the Economist written in contradiction? Then the new Eurodollar Enterprises Dictionary of Economics is for you. Yes, from AbeMoronics to ZIRP. 0 interesting, reasonable policies. Confidently leaf through your folio to define Yellenism, Powellution and Greenspam. Money, a noun, is defined as a blessing that is of no advantage to us, excepting when we part with it. What is a synonym for wealth? Impunity. What is the compound word for making economics erotic? Bernanke-panky. The new Eurodollar Enterprises Dictionary of Economics. New from Eurodollar Enterprises.